my insane stock market predictions for 2025. I need you to remember this. The stock market is not the economy, and 2025 will be like no other. Welcome. On this channel, we focus on the real driving factors and tools that actually give us insight into on what's likely going to happen. If you stick to the end, hopefully you'll see some information you wouldn't find anywhere else. So there are only a few categories we need to understand well enough to get a sense of what the stock market should do. Here's what we'll cover. Political incentives. Charlie Munger said, understand incentives, and I'll show you outcomes. Global flow of capital. Money seeks yield, and it doesn't matter where that money originated. Interest rates, the easier it is to borrow, the better it is for markets. Tariffs, or at least the side of tariffs that hasn't been discussed. Employment and other economic factors, which you typically hear about, but are minor in comparison to everything else. There's good and bad to this, so let's get into it. Currently ending 2024, we will have President Donald Trump claiming office. With minds like Elon Musk by his side, we can begin to see politically the landscape we are in for. Both Trump and Musk have demonstrated a history of fostering business-friendly environments. Trump's policies are often perceived as beneficial for markets, which could lead to growth in U.S. stocks, real estate, and cryptocurrency. Notably, Trump has expressed his desire for the U.S. to take the lead in the crypto space, signaling a bullish future in this sector. One under-discussed market indicator that confirms this is time cycles, and no, not the pseudoscience associated with crystal balls, but real cause and effect economic cycles. For example, the first year of a new presidency is often strong because markets tend to price in optimism and anticipate favorable policies. Historically, this pattern reflects actual investor behavior, such as increased business confidence, government spending, and regulatory changes that stimulate economic activity. This makes these cycles reliable as they are driven by concrete factors that affect the market rather than random fluctuations. Now imagine you had a tool that you could look at which accurately predicted recessions. Well, you do, and the Fed gives us it. This tool is called the Smoothed U.S. Recession Probability. This tool shows no recession in sight. Basically, political incentives seem to be aligned to a strong market. Next, let's move on to the flow of global capital. Currently, the world is looking like it's in a tough spot, the United States included. However, compared to everywhere else, it seems like a much more favorable place to invest. This will cause a further uptick in markets. Remember, money seeks yield. It doesn't matter where it comes from. Because so many countries are currently struggling, money is flowing to the U.S. market. This is good for U.S. markets. Next, interest rates. This is where Fed speech gets the best of us. It's pretty clear the Fed doesn't believe a 2% interest rate is ideal going forward. At 2%, it doesn't give them any real ability to stimulate the economy, which is really the ability to stimulate spending or purchasing. What you typically want is an economy that can handle 8% interest rates and a working class that can pay it. We don't have that and are well off pace from it. What is realistic is the U.S. maintaining 5% going through 2025. Not bad for markets, but not great either. Next, everyone's favorite, not really, tariffs. While optimism is high, there's a critical challenge we must address: tariffs. Tariffs under President Trump are often portrayed as beneficial to the U.S., but they come with nuances that many overlook. There are two main types of tariffs to consider, and Trump has not clarified which he intends to prioritize. Output tariffs. These are the ones Trump has discussed openly. For example, the U.S. might tax imported Canadian cars at 25%. The idea is that this would either generate tax revenue for the U.S. or reduce imports, encouraging more cars to be made in the U.S. While this seems like a win-win for the U.S., it often leads to negative consequences. A significant output tariff could provoke retaliation from trading partners, leading to quote-unquote trade wars, which typically result in other countries imposing their own tariffs on U.S. goods. This historically leads to an increased cost of goods for U.S. consumers. In the long term, the risk is that these tariffs could slow economic growth, create market volatility, and disrupt established supply chains that businesses rely on for efficiency. Historically speaking, tariffs are better at slowing economies than growing them, mainly because other countries raise their tariffs in response. Input tariffs. These are less discussed, but potentially more impactful. Input tariffs tax certain parts, not total production, where Donald Trump is suggesting taxing the total car at 25% coming over from Canada. Input tariffs would only tax specific parts or brands. This would allow trade to change accordingly to find the more beneficial outcome for both parties. These are the more peaceful and beneficial tariffs. The key risk with tariffs isn't the type of tariff, but the response, which the U.S. doesn't have control over. Next, employment and other economic factors. Truthfully, I worry about leaving this to the last point, as this is where most YouTubers will kick off their videos. Traditional economics talks about employment, gross domestic product, and earnings. Although these play part, I don't see them as determining factors, or at least not when they are within a reasonable range. Yes, some companies will have good earnings and some will miss, but when looking at the market as a whole, there are more important factors. I think we will see a disconnect between employment, incomes, and the stock market. Remember how I started the video? The stock market is not the economy. The short version is that incomes won't rise rapidly, but the cost of some essentials might. There has been a noticeable shift in employment trends, with some people opting to stay home for lower incomes to avoid the costs and time associated with commuting. For this reason and others, a rise in unemployment may not cause significant disruption. But can we truly trust the employment data? Likely not. Throughout 2024, the reported numbers have been repeatedly revised downward each month, yet no one seems to question it. So yes, expect economic data to continue to look questionable, yet the stock market might not reflect it. So what's all this mean for the overall market? Well, kind of bullish. Keyword, kinda. Massive 20% or 30% gains aren't likely, but single-digit returns are possible. With all predictions, new economic data can change your original assumptions. That's the reality of investing. If you want to stay up to date and see how predictions like this play out, make sure to subscribe and comment below. Until next time, signing off.